Well, good morning. I am Jaginder Rana. So, topic of the day is enhanced policyholders protection. Enhanced policyholders protection. The Indian insurance market is in an exciting phase of development. The market has always been considerably underinsured, and this has always made India strategically important for international investors. But three key developments are driving further change. First is the regulatory and market developments are facilitating greater merger and amalgamation activities. Second, the emergence of new distribution channels is encouraging new opportunities. Third, the advent of disruptive technologies and the emergence of insurance tech, or you can say insurtech, is also influencing the development of the insurance landscape. So the main trends are affecting the insurance industry a lot. A number of developments are influencing merger and amalgamation activities and investment opportunities in this sector. The foreign direct investment cap has been increased from 49% to 74%, and the previous restrictions on Indian ownership and control, which affected broad composition and affirmative voting rights, have been removed. So these are facilitating greater strategic investment in the sector from the large international insurers, both in relation to greenfield investments as well as the increase in stakes in existing joint ventures. So the Insurance Regulatory and Development Authority has imposed certain requirements that accompany the higher FDI cap, including residency requirements for directors and key managerial personnel, the requirement for a higher retention of net profits for insurers with low solvency margins, where foreign investments exceeds 49%, and enhanced corporate governance requirements in relation to independent directors, but these have not been seen to be problematic by the market. Second, there is significant interest in the insurance sector from financial investors, and the amount of dry powder which can be invested in this sector and is generating new transaction opportunities. So apart from traditional private equity funds, certain prominent family offices have also been active in the insurance sector. Private equity funds have invested not only in the shares of listed insurers, but also in certain unlisted insurers as well. The IRDAI does have private equity guidelines which imposes a 5-year lock-in requirement whether the funds are promoters, that is, they hold a stake of at least 10% in the relevant insurer, or restricts leverage and require undertakings from the relevant funds to subscribe for securities issued by the insurers in any right issue. So this means that such investments are perhaps less liquid than traditional private equity investments and require the commitment of incremental capital. So private equity investors also need to open to contractual provisions in the shareholders' agreement that they would perhaps be less inclined to accept another contract as they are effectively financial investors in strategic joint ventures. However, despite these considerations, the opportunity has led to certain high-profile financial investments by private equity and family offices. Third, the approach of Reserve Bank of India is likely to shape M&A activities in this sector. The RBI has become increasingly focused on the capital adequacy of banks and has been encouraging banks to limit their holdings in insurers as they insurance sector layers on its incremental capital requirements. So investment by banks in the insurance sector has always been regulated. The Banking Regulation Act 1949 limits investment by banks in the shares of other companies, a cap of the lesser of 30% of the paid up share capital, and Reserve Bank of the target company or 30% of the paid up capital in Reserve Bank. Reserve of the bank applies. So in 2021, press reports indicated that the RBI was considering a lower limit of 20%. The RBI has not yet formally notified a change of position in this regard, but given the fact that the several insurers have significant investment from banks, any changes have the potential to affect the deal landscape. So the RBI's approach has also affected the certain recent transactions. For instance, Axis Bank's investment in Max Life was only approved after the direct investment percentage was reduced to below 10%. Fourth, the distress of certain large Indian conglomerates with insurers has generated opportunities for new entrants to acquire the insurers held by distressed group. This may be a temporary phenomenon, but it is a feature of the current deal landscape nevertheless. As far as distribution channels are concerned, it is often said that distribution is everything in the insurance business. However, certain features of the Indian regulatory landscape have influenced the way in which the market has evolved. The IRDA registration of the Corporate Agent Regulation 2015 states that an insurer cannot require an agent to insure every client with it. Also, agents are required to have a policy on open architecture. So these fall short of restricting exclusively what the IRDA does interpret. These requirements restrictively in practice. There are also caps on commission payments to insurers, and the IRDA closely monitors payment for other services to agents. But this does restrict some of the contextual comfort that both insurers and agents seek in their distribution agreements, and incentives alignment has therefore sometimes been achieved by banks investing in insurers. So particularly in life insurance, where bancassurance is the main distribution channel, this has been one way of aligning interests. However, this is becoming increasingly difficult as the RBI increasingly views banks' investment and insurers as being capital inefficient. This partly because of these restrictions and partly because mobile connectivity has created a large online customer base. Insurers are increasingly looking to digital distribution channels. So this is perhaps more the case in general and health insurance, but the trend is distinct. And the digital disruption is there. As in other sectors, digital technologies are influencing the insurance landscape in a variety of ways. Traditional insurers are looking at ways to improve the user experience and offer greater individualization through digital means as a competitive differentiator. Also, various technology investors and the family offices of the founders of technology companies have started expanding their investment footprint to cover insurance. So as a result, the market has seen the advent of online insurers, web aggregators, and various new distribution models. As in the case of other sectors, the law is playing catch up with technological advances, and some of the business models that are evolving challenge the existing regulatory construction. So legal activity or legal creativity may be needed to move transactions forward. Also, the IRDAI is open to innovative insurance tech products and has a regulatory sandbox scheme. So interested parties are able to put forward proposals to the IRDAI in relation to innovative products. The IRDAI may approve license for an initial period of 6 months, extendable by a further 6 months if an approval is considered successful. So these are exciting times in the insurance market in India. The change in the FDI cap may result in structural changes as international investors increase their stakes in joint ventures in India, and as new participants enter the market. Technology may also influence distribution strategies and may lead to new entrants with a strong digital footprints being more active in the insurance sector. Lawyers will need to be nimble and the law will need to evolve and keep pace with the technological developments. So in addition, the RBI's approach to banks, investments and insurers is a key development which could drive M&As with so many drivers of change, international insurers, financial investors and other market participants will all be watching this space with great interest. So as per an economic survey, insurance penetration in India stands at some year 4%, reflecting a 4.2%, reflecting a low level of coverage within the population. However, this figure underscores a promising landscape for potential growth and expansion within the insurance sector in the country. So with the goal to ensure insurance for all by 2047, Insurance Regulatory and Development Authority of India has recently introduced the Insurance Regulatory and Development Authority of India Protection of Policyholders' Interest, Operations and Allied Matters of Insurers Regulations 2024, and which came into force on April 1st, 2024. So these guidelines aim to protect the interest of the policyholders to ensure that the conduct of the insurer and distribution channels are not prejudicial to the interest of the policyholder. So it's a significant step in ensuring the transparency and fairness in the insurance sector. The key highlights of these regulations includes the recent guidelines introduced by IRDAI bring several key highlights aimed at enhancing transparency and protecting the interest of policyholders in the insurance sector. So as per Rule 6, it is the obligation of the insurers to ensure that both the policyholder and potential policyholders have fair and inclusive access to insurance products and services, whether through direct channels or distribution networks. So as per Rule 9, every insurer shall develop and maintain a prospectus which shall contain the information of every retail insurance product, including the features, benefits, rates, grievances, decision mechanism, etc. As per Rule 13, insurance policies that meet defined criteria will be issued electronically, promoting efficiency and accessibility for policyholders. Then as per Rule 18, to ensure thorough coverage, every life insurance policy must include a nomination. The insurer shall provide a facility to the policyholder for changing their nominees. Additionally, the insurer, while issuing the general and health insurance, shall obtain the nomination at the time of issuance of new policies and at the time of renewal of policies. Then as per Rule 20, every policyholder will now have a free look period of 30 days starting from the date of receipt of policy document. So regardless of how they are acquired, the policyholder reserves the right to cancel the policy during the free look period, and the insured shall refund the premium within 7 days from the date of receipt of the request. So as per Rule 22, every insurer or the distribution channel shall ensure that they provide necessary support and guidance for registering claims, necessary specific documents which are required to support the claim, and procedure to be followed for settlement of claims. And then as per Rule 25, every insurer shall establish a system and a procedure for receiving, registering and disposing of grievance, and shall publish such procedures on their concerned website. So additionally, the insurer shall also publish the availability of options to the complainant for taking up grievance with insurance ombudsman if their grievances are not resolved to their satisfaction. And as per Rule 27, insurers are no longer required to submit the advertisement to the authority, thereby reducing their administrative burden. However, the insurers should ensure that the information provided in the advertisement is fair and true, and shall also reflect the potential risk with the products so offered. It shall also reflect the registered name of the insurer along with its state name, monogram, etc. No advertisement shall make any claim whereby it impacts the potential customer's ability to recognize and understand the advantages of insurance products or makes promises that are beyond what the policy can reasonably deliver, or fails to disclose important conditions of the policy, or contains any false or fabricated facts, figures, and features. And then, as per Rule 30, insurers that meet the following criteria are permitted to open the business within India without obtaining the prior approval of the authority. The regulations have provided different criteria for the insurer who have completed 5 years of operations and the insurers that have not completed 5 years of operations. So insurers that have completed 5 years of operation have minimum control level of solvency in the preceding 3 financial years, and expenses of management are within the limit specified under the regulations on expenses of management in the preceding financial year. The insurers that have not completed 5 years of operations, minimum control of level of solvency to be maintained as proposed in the business plan submitted in IRDA, has received forbearance under the expenses of management regulations within the first 5 years of commencement of its operations. So if the insurers do not fulfill the above mentioned criteria, then they are required to obtain the approval from the competent authority and shall open the business within 1 year from the date of approval. So in the IRDA Protection and Policyholders Interest Operations and Allied Matters of Insurers, Regulation 2024, presented new era of enhanced policyholder protection, streamlined operations, and increasing transparency in the insurance sector. The introduction of an extended free lock period, nomination requirements for comprehensive coverage, and issuance of insurance policies through electronic mode all contribute to empowering policyholders and promoting informed decisions making. Furthermore, the streamlined operations for insurers, including the elimination of advertisements, filing, simplified business opening procedures, and removal of outsourcing reporting requirements, not only reduce administrative burden but also foster efficiency and competitiveness. So collectively, these regulations signifies a proactive approach by regulatory authorities to adapt to the evolving industry dynamics and protecting the interest of the policyholders and insurers alike. Thank you. Thank you very much.